Building passive income with cryptocurrency is one of the most accessible paths to financial freedom in 2025, and unlike traditional passive income that requires massive capital or complex real estate deals, crypto offers multiple income streams you can start with as little as $100. While most people trade crypto hoping for quick gains, smart investors focus on building systematic passive income that compounds over time. In this comprehensive guide, I'll show you 7 proven methods for generating crypto passive income, how to manage risks, and how to build a diversified income portfolio that could eventually replace your day job. Before diving into specific strategies, let's understand what crypto passive income really means and why it's superior to traditional passive income methods. Defining crypto passive income. True passive income requires minimal ongoing effort after initial setup. Minimal time investment. Income continues without daily management. Systematic returns. Predictable income streams with known risk factors. Scalable systems. Ability to increase income by adding more capital location. Independence. Income generation not tied to physical presence. 24/7 operation. Crypto markets never close. Income generates continuously advantages over traditional passive income. Lower barriers to entry. Traditional passive income often requires significant capital. Real estate typically requires $50,000 for meaningful returns. Dividend stocks need $100,000 for significant monthly income. Business ownership requires substantial capital and ongoing management. Crypto alternative start building income streams with $100,000 higher yield potential. Crypto offers significantly higher yields than traditional methods. Traditional banks, 0.52% annual returns. Stock dividends, 2.4% annual dividend yields. Real estate, 8.12% annual rental yields in good markets. Crypto yields 5 to 25% annual returns depending on strategy and risk. Global accessibility. Crypto passive income is accessible worldwide. No geographic restrictions, available regardless of location, no minimum net worth. Unlike many traditional investment products, 24/7 access, always available regardless of time zone. No middleman required, direct access to protocols and platforms. Innovation and growth. Potential crypto space continues expanding with new opportunities. Emerging technologies. New protocols creating new income opportunities. Institutional adoption, growing legitimacy, attracting more capital, regulatory clarity, improving regulations, creating more opportunities. Infrastructure development, better tools making participation easier, risk considerations. Honest assessment of crypto passive income risks, volatility. Risk. Underlying assets can fluctuate significantly. Smart contract risk, technical vulnerabilities in protocols. Regulatory risk. Changing regulations affecting income streams. Platform risk. Centralized platforms may face issues or bankruptcy. Complexity. Risk. Technical complexity may lead to user errors. Staking is the most straightforward crypto passive income method, offering steady returns for supporting network security. Understanding proof of stake, staking. Earn rewards by participating in blockchain network security. Network security. Your staked tokens help secure the blockchain network. Block validation. Stakers validate transactions and create new blocks. Reward distribution. Network distributes new tokens to stakers as rewards. Lockup periods. Some networks require tokens to be locked for specific periods. Slashing risk. Risk of losing tokens for malicious behavior. Usually minimal for delegated staking. Top staking opportunities. Ethereum, ETH. 3, 5% APY. The largest and most established staking opportunity. Minimum 32 ETH for solo staking, no minimum for liquid staking. Liquid staking. Services like Lido, Rocket Pool, Coinbase allow smaller amounts. Risk profile. Lower risk due to network size and established technology. Getting started, use liquid staking services for smaller amounts. Solana SOL. 68% APY high performance blockchain with attractive staking yields. Minimum. No minimum for delegated staking. Flexibility, easy to stake and unstake with 2 to 3 day waiting periods. Validator selection, choose from hundreds of validators. Risk factors, network occasionally has stability issues. Cardano ADA, 4 to 6% APY research focused blockchain with user friendly staking. Unique features, no lockup period, tokens remain liquid. Minimum, no minimum stake required, pool selection. Choose from thousands of stake pools. Risk profile, lower technical risk, established network Cosmos Atom. 15 to 20% APY hub of interconnected blockchains with higher yields. Higher yields, attractive returns, but with higher inflation. Unbonding period, 21 days to unstake tokens. Ecosystem benefits, exposure to broader Cosmos ecosystem, risk considerations, Higher inflation may offset yield benefits. Staking implementation strategy: start small, begin with established networks and small amounts, diversify, spread staking across multiple networks. Research validators: choose reputable validators with good performance, monitor performance, track rewards, and validator performance. Compound returns: regularly restake rewards for compound growth. Decentralized finance offers multiple opportunities for earning yield through lending and liquidity provision. DeFi lending platforms, Compound and Aave, 2 to 8% APY established lending protocols with proven track records. How it works: lend crypto assets to borrowers, earn interest. Supported assets, wide variety of cryptocurrencies and stablecoins. Variable rates, interest rates change based on supply and demand. Risk management, over collateralization protects lenders. Getting started: connect wallet and deposit assets to start earning curve finance. 3 to 15% APY specialized in stablecoin trading and liquidity provision. Focus: optimize for stablecoin and similar asset trading, liquidity provision. Provide liquidity to trading pools. Earn fees: CRV rewards, additional rewards and curves, native token, risk profile. Lower impermanent loss due to similar asset values. Yield farming strategies: liquidity mining. Provide liquidity to decentralized exchanges. Concept: provide pairs of tokens to trading pools. Rewards: earn trading fees plus platform tokens. Impermanent loss: risk that token prices diverge, reducing returns. Popular platforms: Uniswap, SushiSwap, PancakeSwap. Risk management: choose pairs with lower correlation. Yield aggregators: automated services that optimize yield farming. Yearn Finance automatically moves funds to highest yield opportunities. Beefy Finance, multi-chain yield optimization. Harvest Finance, automated yield farming strategies. Benefits: professional management, automatic compounding fees. Platform fees reduce net returns but provide convenience. Stablecoin yield strategies. Lower risk approaches using stable assets. Stablecoin lending: lend USDC, USDT, DAI for steady returns. Stablecoin LP: provide liquidity to stablecoin pairs. Yield: typically 3 to 8% APY with lower volatility, risk profile. Lower price risk but still smart contract risk portfolio. Role: core conservative yield generation, risk management in DeFi. Smart contract risk: protocols may have bugs or vulnerabilities. Impermanent. Loss: price divergence can reduce liquidity provider returns. Token risk: platform tokens may lose value. Regulatory risk: DeFi regulations continue evolving. Due diligence: research protocols, audit reports, and team backgrounds. Centralized finance platforms offer user-friendly crypto interest accounts with professional management. Leading CeFi platforms: BlockFi, 4 to 8% APY established crypto interest account platform. Supported assets: Bitcoin, Ethereum, stablecoins, major altcoins. Professional management, institutional grade security and insurance. Easy interface. Simple deposit and withdrawal process. Regulatory compliance, registered and regulated in multiple jurisdictions. Risk considerations: counterparty risk, regulatory changes. Celsius, 3 to 7% APY community-focused crypto interest platform. High yields, competitive rates on major cryptocurrencies. Weekly payouts: interest paid weekly in same crypto or CEL tokens. No minimums, no minimum balance requirements. Mobile app, user-friendly mobile application. Important note: platform faced difficulties in 2022, highlighting counterparty risk. Gemini Earn, 2-5% APY exchange. Integrated interest earning. Integration. Built into Gemini Exchange platform. Regulatory focus: strong regulatory compliance and transparency insurance. Some FDIC insurance coverage for USD deposits. Professional grade, institutional security and operational standards. Lower yields: more conservative approach with lower but more stable yields. Nexo, 4 to 12% APY European-based crypto interest platform. Flexible terms, various term lengths and payout options. Credit line: borrow against crypto holdings. Insurance: $375 million insurance policy. Compliance: strong European regulatory compliance, token benefits. Higher yields for holding platform tokens. Risk assessment for CeFi platforms: counterparty risk, platform bankruptcy or mismanagement. Regulatory risk: regulatory actions affecting platform operations. Insurance coverage: understanding what is and isn't insured. Transparency: platform disclosure of lending practices and risks. Geographic risk: regulatory differences across jurisdictions. CeFi versus DeFi comparison. Ease of use: CeFi generally more user-friendly. Yields: DeFi often offers higher yields but with more complexity. Risk profile: different risk types. Chancha tried Counterparty versus smart contract control. DeFi offers more control, CeFi offers more convenience. Portfolio allocation, many investors use both for diversification. Some cryptocurrencies and tokenized assets provide regular dividend-like distributions. Crypto dividend tokens, Qcoin shares, KCS, variable dividends, exchange token with profit sharing. Revenue share. Holders receive portion of exchange trading fees. Daily distributions, dividends distributed daily, burn mechanism. Token supply reduces over time. Exchange risk, performance tied to Qcoin exchange success. Yield variability, returns depend on exchange trading volume, crypto.com. Coin, CRO. Staking rewards, exchange ecosystem token with multiple benefits. Credit card rewards, enhanced rewards for cardholders. Exchange benefits, reduced trading fees and higher yields. Staking rewards, direct staking rewards, plus ecosystem benefits. Mainstream adoption, growing mainstream recognition and usage, Binance Coin, BNB. Launchpad and staking world's largest exchange ecosystem token, trading fee. Discounts, reduced fees on Binance Exchange. Launchpad access, early access to new token launches. Staking options, various staking and savings products, ecosystem benefits, multiple use cases across Binance ecosystem, burn program, quarterly token burns, reducing supply, tokenized real estate, REITs, Realty, 10-14% APY tokenized real estate investment platform, property ownership, fractional ownership of real estate properties, monthly distributions, rental income distributed monthly geographic diversity, properties across different US markets. Transparency, full property details and financial information. Liquidity, trade tokens on secondary markets. Fundrise, 8-12% APY. Real estate crowdfunding with crypto integration, professional management, institutional real estate management. Diversified portfolio, multiple property types and markets. Quarterly distributions, regular dividend distributions. Growth potential, property appreciation plus rental income. Lower minimum, accessible with smaller initial investments. Dividend token investment strategy, due diligence. Research underlying business models and sustainability. Diversification. Don't concentrate too heavily in dividend tokens. Reinvestment, consider reinvesting dividends for compound growth. Tax considerations, understand tax treatment of dividend distributions. Risk assessment, evaluate business model sustainability and competition. More sophisticated strategies for experienced crypto investors seeking higher yields. Method 5. Liquidity mining and DEX rewards. Automated market maker, AMM, liquidity. Provide liquidity to decentralized exchanges. Concept, deposit token pairs to enable trading on DEX. Rewards, earn trading fees plus platform tokens. Popular platforms, Uniswap, SushiSwap, balancer yield range. 10-50% APY depending on platform and pairs. Risks, impermanent loss, smart contract risk, token volatility, balancer protocol, 5-25% APY multi-asset liquidity pools with customizable weights. Flexibility, create pools with different asset ratios. Self-balancing, pools automatically rebalance as prices change. BAL rewards. Additional rewards in balancer tokens. Portfolio benefits, maintains diversified exposure while earning yield. Method, 6 options, writing and derivatives. Income covered, call writing, generate income from crypto holdings. Strategy, sell call options on crypto holdings. Income, collect option premiums as income. Risk, may miss upside if crypto prices rise significantly. Platforms, Deribit, Ribbon Finance for automated strategies. Yield, 5-15% APY depending on market conditions. Put selling generate income while potentially acquiring crypto at lower prices. Strategy, sell put options on cryptocurrencies you want to own. Income, collect premiums while waiting for attractive entry points. Risk, may be forced to buy crypto at higher than market prices. Benefits, income generation plus strategic position building. Method 7, masternode and node operation masternode operations. Run network infrastructure for proof-of-stake networks. Requirements, significant token holdings and technical setup. Rewards, higher yields than regular staking, 15-25% APY. Technical complexity, requires technical knowledge and maintenance. Examples, Dash, PyVX and other masternode supporting networks. Risks, technical complexity, higher capital requirements. Validate a node. Operate validation nodes for blockchain networks. Professional setup, requires technical expertise and infrastructure. Higher rewards, potentially higher yields than delegated staking responsibilities. Maintain uptime, perform updates, manage security, risk factors, slashing penalties for poor performance. Capital requirements. Significant token holdings required advanced strategy risk management. Complexity risk. More complex strategies require more knowledge and management. Capital requirements. Advanced strategies often require larger initial investments. Technical risk. Smart contract and operational risks increase with complexity. Professional advice. Consider professional guidance for advanced strategies. Portfolio allocation. Limit advanced strategies to smaller portfolio percentages. Creating a diversified crypto passive income portfolio that balances yield, risk, and sustainability. Portfolio construction principles. Risk-based allocation, structure portfolio based on risk tolerance. Conservative 60-70%. Stablecoins, Bitcoin, Ethereum staking. Established CeFi moderate 20-30%. Major altcoin staking. Established DeFi protocols aggressive 10 to 15%. High yield DeFi, newer protocols, advanced strategies. Income stream diversification, spread income across multiple sources. Platform diversification, don't concentrate on single platform or protocol strategy. Diversification, multiple income generation methods. Asset diversification, different cryptocurrencies and asset types. Geographic diversification, platforms and protocols in different jurisdictions. Yield versus sustainability, analysis, evaluate long-term sustainability of income sources. Sustainable yields, 3-12% APY from established sources. Unsustainable yields, 50% plus APY often indicates unsustainable tokenomics. Business model analysis, understand how platforms generate revenue to pay yields. Token economics. Evaluate whether token rewards are sustainable long-term sample portfolio allocations. Conservative portfolio $10,000. Stablecoins 40% $4,000. USDC on compound Aave at 4% APY ETH staking 30% $3,000. Liquid staking at 4% APY BTC interest 20% $2,000. CeFi platform at 3% APY blue chip altcoins 10% $1,000. Cardano staking at 5% APY expected income. So 35-month, 420-year. Balanced portfolio, $25,000. Stablecoins, 30%, 7,500. Mixed lending platforms at 5% APY major crypto staking, 35%, 8,750. ETHs, Sol, Addis staking at 5% APY DeFi protocols, 25%, 6,250. Established DeFi at 8% APY dividend tokens, 10%, 2,500. Exchange tokens at 6% APY. Expected income. 125-month, all in 500-year aggressive portfolio, 50,000. Stablecoins, 20%, 10,000. High yield DeFi at 8% APY crypto staking, 30% $15,000. Multiple networks at 7% APY DeFi yield farming, 30% $15,000. LP and yield farming at 12% APY. Advanced strategies, 20% $10,000. Masternodes, options at 15% APY. Expected income. 450-month, 5,400-year implementation. Timeline, month 1. Start with stablecoin lending and major crypto staking. Month 2 to 3. Add established DeFi protocols and CeFi platforms. Month 4 to 6. Gradually add more complex strategies as knowledge grows ongoing. Regular rebalancing and strategy optimization. Section 8. Risk management and tax considerations. 24 minutes. Protecting your passive income portfolio and understanding tax implications. Risk management framework. Diversification strategies. Spread risk across multiple dimensions. Platform risk. Use multiple platforms and protocols. Asset risk. Different cryptocurrencies and asset types. Strategy risk, multiple income generation methods. Geographic risk, platforms in different jurisdictions. Time risk, stagger investments and reinvestments. Security best practices, protect your passive income assets. Hardware wallets, use hardware wallets for long-term holdings. Multi-signature, consider multi-sig for larger amounts. Platform research, thoroughly research platforms before depositing. Insurance, understand and utilize available insurance options. Regular monitoring, monitor all platforms and positions regularly. Emergency fund management, maintain liquidity for opportunities and emergencies. Cash reserves, keep 3-6 months expenses in traditional savings, stablecoin reserves, additional reserves in high-yield stablecoin accounts. Quick access, ensure some investments can be accessed quickly. Opportunity fund, reserve capital for new opportunities. Tax considerations, income tax treatment. Understanding how crypto passive income is taxed. Ordinary income. Most crypto yields taxed as ordinary income when received. Fair market value. Income calculated at fair market value when received. Record keeping. Detailed records of all income and sources required. Estimated taxes. May need to pay quarterly estimated taxes. Tax optimization strategies. Legal strategies to minimize tax burden. Tax advantaged accounts. Use retirement accounts where possible. Geographic strategy. Consider tax-friendly jurisdictions. Timing strategies. Manage timing of income recognition. Professional advice. Consult tax professionals for complex situations. Ongoing management. Performance tracking, monitor yields and returns across all strategies. Rebalancing, regular portfolio rebalancing to maintain target allocations. Strategy updates, adapt to changing market conditions and opportunities. Tax planning, regular tax planning and compliance management, professional development. Continue learning about new opportunities. Building passive income with crypto is one of the most accessible paths to financial freedom available today. While it requires learning and careful risk management, the potential to generate meaningful income streams is real and achievable. Here's how to start building your crypto passive income portfolio. First, subscribe to this channel for ongoing passive income education, yield updates, and new opportunity analysis as the crypto income landscape evolves. Second, start with conservative strategies like stablecoin lending or major crypto staking with small amounts to gain experience before moving to more complex approaches. Finally, share in the comments your passive income goal. Whether it's $500 month, $2,000 month, or full job replacement, let me know what you're working toward. Remember, building meaningful passive income takes time, patience, and systematic approach. Focus on sustainable yields, manage risks appropriately, and let compound growth work in your favor over time.